Hey everyone, I'm back. I want to talk about SVB today, Silicon Valley Bank. What happened at that bank? Why did it collapse? But then it was brought back by the FDIC. I want to go through all the steps because going through those steps is very illuminating to me as a dividend investor because I then looked at a dividend stock. I own a smaller one with a high yield. And I see some risk on their balance sheet. And so I learned about that risk from SVB. So I want to share that with all of you today. Actually, I think that dividend stock will be fine and I'll probably buy a little more, but there's some risk and that's why the stock has plummeted. And so that's going to be fun to go through that. I want to go through 6 lessons I learned from SVB that helped me as a dividend stock investor. But first, a fun example. Let's just assume that this is the bank. This is the Bank of Louis Vuitton right here. And it's good that I call this a bank because literally this company prints money, just like the central bank that is. And so put in the comments below if you own any LVMH brands. And shout out, by the way, to the Dividend Talk podcast. It's a dividend podcast with a European flavor. I was just a guest. I'll link in the pinned comment. And I'm so honored to be a guest. I'll link in the pinned comment to my episode, the recent one that I was on, the Dividend Talk podcast. But let's go to the example really quick because I think this will illustrate kind of what happened with SVB, but then I'm going to go into the specifics as well in text format. So let's assume I'm a startup founder and I got some funding from the venture capitalist. The venture capitalist raised a lot of funds and gave it to me, said, Ian, go run your business. So I got $100. Here it is. Here's your 100, Ian. Put it in the bank. And so here's the bank. I go to the bank. I open the bank. I deposit the money into my account. There it is, and zip it shut. It is there for safekeeping. And so I'm going to use that money for payroll later to pay my employees because I'm a small business owner in this example. But all of a sudden, I don't need it quite yet, but I get a phone call, ring, ring. The venture capitalist calls me back and says, Ian, you get down to that bank and get your money out of the bank because I think there might even be a run happening on the bank because their balance sheet is really bad. Anyway, I try to go to the bank and I try to get my money out. Let's open the account. Here it is. And where's my $100? Oh my goodness, it's not there anymore, but I got a bunch of 20s. What's going on here? And so look, let's see how many. 1, 2, 3, 4. And so that $100 is now worth $80. I go to the bank. I try to get my $100 out. They say, sorry, Ian, we don't have your $100 anymore. The books don't add up anymore. Our liabilities are greater than our assets because what happened is when I deposited the money, they invested it in a long-term treasury. The value of that treasury bond fell because the interest rates have been going up so quickly. And when interest rates go up, the treasury value drops. Now, the bank would have gotten the full value if there wasn't necessarily a run on the bank and they could hold those treasuries through maturity, but they couldn't. There was a run on the bank. And so everyone needed their money. They were forced to liquidate those treasuries for, in this particular example, 80 cents on the dollar, and the money is not there. They cannot make the depositors whole. FDIC gets involved, makes everyone whole. That, in a nutshell, is kind of what happened at a very high level, to my knowledge, with Silicon Valley Bank. But I look forward to going into it in a lot more detail in the video today. Everyone, get ready for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. I hope you enjoyed my fun example in the introduction today. And again, put in the comments below if you own LVMH brands. But I want to get into exactly what happened in a text format, step by step with Silicon Valley Bank, because it really tells a lot about being a financial stock market analyst as a dividend stock investor. As you can see on the screen right now, here it is step by step. Step one, to my knowledge, by the way, all of this is subject to change. This is to my knowledge based on what I have read. There was a huge influx of business accounts at the bank. At SVB, it catered to businesses, and there were a lot of new accounts and a lot of new money all of a sudden, because over the last few years, quite frankly, there's been a lot of startups that have been founded and have been well funded. Now, what happened with all this cash coming into the bank, and cash that comes into the bank, by the way, these are liabilities of the bank, the deposits, but they can turn those into assets by taking the liabilities and investing the money. And that's what they did. They invested it into longer term treasuries. Well, that was a mistake, because what happened is interest rates subsequently skyrocketed. We know the Federal Reserve, the Fed funds rate, it's been going up. And when interest rates go up, the value of existing treasuries goes down. Treasuries are securities. They're traded. I own them. They trade on the open market. And if I buy a treasury and let's say interest rates go up, the value of my treasury, if I want to sell it to someone, it's lower than what I paid for it. Now, if I hold it to maturity, I'm just fine because the government will pay me back the full treasury amount. But unfortunately, at a bank, in a forced liquidation scenario, they weren't really in a scenario where they're like, hey, let's wait till maturity. That would have been nice. You're going to see in a second. They were more subject to the prevailing market forces that were pricing these securities in real time. But we know that treasuries, the value goes down when traded on the market if interest rates go up. And the simple reason for that is new treasuries are issued all the time. And if I can get a brand new treasury at a higher interest rate, the older one that someone already owns, if they want to sell it to me, they have to sell it to me for less than the face value to get the interest rate up higher on parity to the existing new treasuries. But as you can see on the screen right now in front of you, basically what happened is under number 4, the value of the treasuries dropped. And again, under 4A, it would have been fine and nice if they could hold towards maturity, but they couldn't because there was a run on the bank. And when there was a run on the bank, they had to take all of those assets and liquidate them, the long-term treasuries. And when they liquidated them, they're worth less than what they put into them. And when they liquidated it all, unfortunately, all of those assets that now turned from treasuries into cash, it wasn't enough to meet the demand of the depositors withdrawing their own money, the liabilities of the bank. The bank was insolvent, number 7. And so that's at the very point that we had all this bad news and the FDIC came in. Thankfully, the FDIC, they decided, hey, usually they just guarantee $250K per depositor, but this is a different kind of bank. This is a bank of businesses, and these businesses need to make payroll. And so the FDIC said, hey, instead of just doing $250 per depositor, we're going to make this whole thing whole. We're going to make sure that no one of the depositors lose their money. All of the shareholders in SVB, all the executives who had all the stock, they lose everything, but the depositors, the startups who put the money that they raised from venture capital in that bank and had it there because they wanted to use it for payroll, all of that money is fine. So FDIC, by the way, as you can see on the screen here, check it out, under number 10, to my knowledge, this will not come out of taxpayer money, and this is a common misconception with what happened. Actually, FDIC, it's an insurance branch of the government, and what happens is the member banks, they all pay into it. All the member banks, SVB included, they all paid into FDIC. And the reason they pay into it is if a bank collapses, the insurance will pay out the depositors at the bank. Now, in this particular case, the FDIC used their judgment and said, hey, and the government was involved too, the Treasury too. They said, we're not just going to do $250K per account because that makes no sense. This is a bank of businesses that have much more money than that. We're going to make everyone whole. And that was really good because they, in my opinion, by doing that, they avoided a domino effect of tons of people losing jobs and losing their source of income, everyday people, which would have been terrible and catastrophic for our economy and probably would have caused our stock market to collapse, in my humble opinion. Now, the reason this doesn't come out of taxpayer money is this is money that was raised by the member banks. They all pay into FDIC, not necessarily the taxpayer, to my understanding. Now, in the future, could this kind of hit consumers like you and me, maybe there will be higher bank fees. Maybe interest rates will be higher because if FDIC insurance is going to be more expensive in the future because they're going to cover more than just $250K at these different banks, FDIC is going to have to raise more money for their insurance, and that money is probably going to come from higher fees to their member banks, which may get passed along to consumers. And so that's a possible way it could hit people like you and me. But put in the comments below what you think. If you think the FDIC handled the situation the right way, I think they did, but maybe you disagree, you have a different point of view, please put in the comments below. I was having a fun discussion with a friend of the community who's been following me since the early days over on Instagram, and he was a little more skeptical than me. I was like all about the way they solved it, but he was like, hey, Ian, I have a different opinion. So it'd be fun to have some conversation in the comments below. But next, I want to talk about the stock that I own. I own Bank of Hawaii, ticker BOH. It's a small $2 billion company. Since this whole thing with SVB happened, that bank has plummeted. Check it out on the screen, actually. I have actually two banks I own, Bank of Montreal, ticker BMO, and I also have Bank of Hawaii. And I put them side by side just because some people may think now that BOH, just because it's down 42% almost, is a huge value. But when I look at it side by side with BMO, I actually see that it's trading at a higher PE than BMO. And I haven't looked at the balance sheet of BMO, but I'm probably pretty certain, being just such a big company at 62 billion, BMO could probably weather more storms than Bank of Hawaii. And so I have a little more confidence in BMO, but I love both companies. But anyway, I don't think BOH is such a value yet. But I do like both of these stocks, quite frankly, here at these levels. And so that said, there's some risk. Anyway, but the reason I'm just showing you the screen now is bank stocks overall, they're down. Some may say they're on sale. I think nothing really is on sale unless there's risk. I see risk here, but am I going to take on the conscious risk and maybe make some investments in these banks? Probably. I've bought BMO at higher levels recently, so certainly I'll probably add a little more to BMO. Maybe I'll add some to BOH as well. But what you can see there now is BOH is trading at a PE of 10, BMO in the 9s and 8s next year. BOH has a 5.5% yield, which is awesome. Bank of Montreal, 4.87, and both of them grow their dividends over time, which is great. They're both dividend growth companies. BMO even better than BOH. The BMO growth, by the way, is priced in US dollars. You have to kind of, it's not looked at in the native currency, in the Canadian dollars. I'm looking at it in US dollars, and you can see the market caps. But I wanted to give that quick snapshot just so you know the company I'm looking at is BOH, and I wanted to give a comparison BMO. But now check out on the screen in front of you right now. This is what I wanted to share. This is the balance sheet of BOH, Bank of Hawaii. And so remember in the introduction with my simple example, I was just saying that money in the bank, the deposits, it becomes liabilities. So I want to start with liabilities, which is on the lower part of the screen. You can see the bold that says liabilities, and then you can see deposits, you can see total deposits, and you can see there's different types of deposits at the company. There's non-interest-bearing deposits, interest-bearing deposits, you have savings, and you have time-based deposits. I imagine time is related to CDs maybe. Anyway, they have about $20.6 billion in deposits. And you can see that's up a little bit from the year ago, because the year ago they were at $20.3 billion. And so they have a lot of deposits. And so that's the most important thing I want to look at on the liabilities, although there's some other liabilities as well. Let's go up to the assets, though. So on the top of the page, you can see assets. And one of the things I want to talk about, investment securities. If you look at assets at the top, it's in bold. You go down a few rows, you can see that they have investment securities. And you can see that these investment securities are worth $5.4 billion. A year ago, they were worth $4.69 billion. It looks like they're buying more investment securities. Typically, these investment securities are probably Treasury bonds, if I had to guess. But here's what is so important. There's a row here that says available to sell. Awesome. But then below that, there's a row that says held to maturity. And basically, again, under held to maturity, it's showing what the values are if held to maturity. You have $5.4 billion, and then you have a $4.69 billion. The held to maturity, though, the fair value right now is less. This is what happened to Silicon Valley Bank. They had all these securities, and if held to maturity, they'd probably be fine, but the fair value is a lot less if they had a run on the bank and had to liquidate immediately. Anyway, At Bank of Hawaii, under the held to maturity, if they held to maturity, you've got $5.4 billion of investment securities there, but the fair value of those is about 4.6. And so there's about an $800,000 discrepancy. That's right. If they can hold these investment securities until maturity, they get the full value. If they have a forced liquidation right now because the depositors run on the bank, which we actually know is kind of happening around the country now because there's a lot of news right now that a lot of depositors are pulling their money from smaller banks and going to the big money center banks. If they face something like that and they have to sell these securities, the value right now is about $800,000 on the open market, less than they would get if they just held to maturity. And so as you can see on the screen now, I don't want to spend too much time on this, but what you see all the way at the bottom of total assets right now as of December 31st, 2022, this is the most recent data I could get, they have $23.6 billion of assets. But if you go to total liabilities, it is $22.289. The key here is there's a healthy discrepancy between the two. And so assets minus liabilities is stockholders' equity. And if you look all the way at the bottom, you can see that shareholders' equity is about $1.3 billion. Company is valued at $2 billion, so it's valued over the stockholders' equity. It's probably pricing in future growth of the company. And you can see, though, a year ago, stockholders' equity was higher at 1.6. So there's some risk at this bank that wasn't there a year ago, even as evident through stockholders' equity. But what's really risky is if they have a forced liquidation of those securities we just looked at. I only have $500 million left. $500 million instead of $1.3 billion of stockholders' equity. You can see with even this example, this company would probably be fine even if there was a run on the bank, but they're not doing great. In that particular situation, they're really not doing great. And so this backdrop, this example of Silicon Valley Bank, we can look at the banks that we own, like BOH, which is one I own, and it helps the investor better understand the risk. And so I see the risk at BOH. I understand now why it's down so much. I understand why it's corrected 40%. Is it a deep discount bargain at these levels? Probably not. It's probably priced appropriately for the current market conditions. Am I going to buy some because it pays a 5.5% yield and I believe over time it'll climb back up? Absolutely. And what I also think at a meta level is hopefully the Federal Reserve slows down a little bit on the Fed funds rate increases. And if they do, every day that passes, these securities, these assets that these banks own get closer to maturity and they start kind of laddering in new securities, everything evens out over time. The reason it's so bad right now is interest rates went up really quickly. And I don't know if the banks really, certainly Silicon Valley Bank didn't prepare for that. But we can even see with my BOH, they're underwater on some of these securities. And so I think that's a really important lesson for those of us who invest in banks. Put in the comments below how you look at your bank stocks. Are there any bank stocks you're buying right now? And please don't forget to smash the like button if you enjoy today's video. Fun aside, by the way, I love hip hop music. I listen to it all the time. And as I was getting ready for the video today, I was actually looking up the lyrics to one of the Rick Ross songs that I like so much. I don't want to say the name of this track because it's a controversial name, which is probably not something I could put in the video, but I can quote some of the lyrics from it. So check it out on the screen right now. This is very pertinent to the example that I had in the introduction today. He says, lemons and honey, millions and money, Gucci, Louis Vuitton, specifically homie. And so I just had to quote that today to pay respect to Rick Ross and the introduction today. But here are 6 lessons that I learned from SVB. Check it out on the screen right now. I want to go really quick, but there are some really fabulous lessons. And so the first lesson that I want to go through today is that it's an experiment. All of this is. The bank's broke. No one knew the banks were going to break. I guess some smart VCs might have known right before because they were saying there's going to be a run on the bank. But this is an experiment. All of it is. The financial system in some ways. And so what really has value? In my humble opinion, I'm starting to believe more and more core quality blue chip stocks are the stocks that not only have value for me as a dividend stock investor, but quite frankly, literally as a store of value. What has value? Core quality blue chips. As you can see on the screen right now, and you probably already saw it, throughout all of this mess, the bluest of blue chips, such as Pepsi and McDonald's, they were fine. You can see the charts there. I want to own companies with my money. I want to convert my money, not have it in the bank, all of it. Of course, it's important to have emergency fund. We'll get to that later, and have diversification of assets. But boy, as much as I can feel comfortable with, I want to own companies that have real assets or are assets in their own right. And some of me is thinking right now, are blue chips a better store of value than the US dollar itself? These blue chips have gone through this storm like pros. And so that was lesson number one. And I'm thankful for that because that's what I'm all about as a dividend stock investor. The second lesson I took away from all of this, as you can see on the screen right now, is that there's a flight towards quality. We know right now that regional banking customers are taking their money out. They're running towards those money center banks because they believe they're too big to fail, and customers are transferring funds. I own some smaller stocks, but increasingly, I really believe that it's a winner-takes-all society. And I'm going to tell you, those of you who know about my portfolio, I'll link to a video below. It's an older one, but that's my last portfolio update here on YouTube. I now do them over on Patreon, on Corner Patreon. I'll link to that in the pinned comment. And it's been a while there as well. I'm overdue, Corner patrons. I will do that update video and text update on my portfolio percentage allocation to each position soon. It's on my list. But anyway, those who have seen and understand my portfolio, have watched my videos, know I'm all about the bluest of blue chip stocks. I started out this year saying, hey, Ian, your strategy is your core four, which is your core big kind of money center of sorts, CPG stocks like Starbucks, J&J, Pepsi, McDonald's. Anyway, as the year progressed, I went a little bit more towards high yield, but I did it my own way. I am looking for high yield within my portfolio, and my portfolio of 50 stocks is usually skewing towards bigger companies that are the solid, stable, high-quality blue chips. Now, my strategy for the rest of the year is kind of core five. I added Altria into the core four, and I'm kind of looking at core five plus some higher yielders. But again, I'm doing it my own way. I am going after quality because the 50 stocks I own, generally speaking, they're pure quality. And I have to do that because we live in a world right now that is a flight towards quality. And so that was a huge takeaway that I had from this experience, that when things get really bad, all that matters is quality. Let's keep going. As you can see on the screen right now, the next lesson that I took away from all of this is vice stocks all the way. There is no doubt about it. We live in very stressful times. I was a little stressed out this week. I went to Starbucks today and I felt better. People are saying there's a run on the bank. It's all over. I love investing in the easy comforts of life, the sin stocks. I bought some Altria earlier this week. Coffee, Starbucks and Coca-Cola, which owns Costa Coffee. Comfort foods like McDonald's, salty snack foods, Pepsi, Coca-Cola, Hershey. My kids own that one. These are the companies I love. These are the companies that I own. If we live in a society that is a crazy house of cards right now, that people are really worried about, is my money even in the bank? What is a simple pleasure that everyone can enjoy in? They can go and enjoy a coffee, enjoy a break with one of the products that my sin stocks sell. These are the simple pleasures, simple comforts of a life. I love investing in these companies, especially when they're the biggest and best in their respective industries. As you can see on the screen right now, these vice stocks, quote unquote, went through the week pretty well. Altria 5-day charts a little better than Starbucks, but both of them did a lot better than the banking sector and the personal finance sector, the financial sector. And so I really love that takeaway, that a lot of what happened, it honestly is reinforcing even more. Ian, stay true to your strategy. I know you're tempted by those high yielders, and it's okay to do a little high yield within your own portfolio, but try to stick to what you know, because those quality core stocks, they are getting through all of this really well. But let's keep going. As you can see on the screen, the next lesson that I took away from all of this was anything can happen. Be prepared for the worst. I'm reading the autobiography of Lee Iacocca, the famous auto industry executive. I'm reading that because it was suggested by Peter Lynch in his book. And Lee Iacocca says, no matter how I'm doing financially, the depression, the Great Depression, he's saying, has never disappeared from my consciousness. And so I have not been through the Great Depression, but I've been through a few terrible financial events like the Great Financial Crisis, the pandemic, and now whatever's brewing right now. And I want to plan for the worst, so I'm pleasantly surprised. Sometimes you'll even see me here on YouTube, and I'll have a video like my last one, and I'll share, like, I think things could get really bad. And that's kind of how I think about investing. In sometimes life, I like to think, what is the worst that could happen so I can prepare for it? And I think as a portfolio manager, I'm managing my own portfolio here of 50 dividend stocks. I always want to remember, like Lee Iacocca remembered the Depression, in my consciousness, what was it like in the Great Financial Crisis? It was pretty awful. And that was around the time where I did face a layoff. I'll link to that video in the pinned comment below. That was one of the worst experiences of my life. It was really terrible. I need to remember those kind of things and have them in my consciousness and kind of think about the worst case, because we live in a world where the worst could happen. Hopefully it won't happen, but it could. And so it's important to be prepared and important to have a really solid emergency fund for those situations as well. But let's keep going. As you can see on the screen right now, the next one I want to share with all of you is just Diversify. There is I always talk about diversification by stock. I own 50 of them, but I think this lesson has taught us also, hey, it's probably a good idea to diversify banks, diversify brokers, not have all the eggs in one basket at any single stock broker, diversify by stocks, not have everything in one stock. That's why I have 50. Diversify income streams as well. Discuss the risks of modern living with your partner as well. If you have one, come up with a plan together and always have a contingency plan. But I would say perhaps one of my favorite, I want to leave this on a positive note today because I talk about terrible bank collapse. But thankfully the FDIC saved it. I talk about a stock. I own a smaller one, but one that has risk. And then I talk about some things I learned. Some of them are more positive than others. I think the most positive is, in general, the core quality blue chip dividend stocks for the win. But I want to close on a really positive note here. As you can see on the screen, what I took away from all this is, hey, the government to the rescue. And sometimes I can look at the market and I can think the worst is going to happen. But look, we have an election around the corner. I don't think the government wants a big mess going into the election, and they don't want a broken financial system. I think that it really shocked me, and I don't know, maybe others were more prepared for this. I didn't think that the Treasury, the FDIC, and the U.S. government were going to work so closely, so efficiently to fix this SVB situation so quickly. It was fixed really, really quickly. And so that just gives me a little bit of hope, but it also makes me think, as the skeptic in me, is it really fixed, or is this just an illusion? And if it's just an illusion, it brings me back to the power of owning real operating businesses with real assets like PepsiCo. But anyway, just when I thought things were going to go a lot lower, hey, it's all fixed. And so that's a little bit of optimism. And because I cannot predict where the market's going to go, this is generally speaking why I just typically average into quality stocks, and I never sell them, or almost never sell them. Rarely I sell a stock. I sold a pretty big stock sale on Patreon recently. It was Norfolk Southern. I don't own that one anymore. I believe the risk on that company is still not fully priced in to the share price, the environmental risk. And so anyway, but I have a lot more about that on Patreon, which is linked to in the pinned comment below. Share what all of you think in the comments below. Thank you for watching the video. If you did enjoy it, don't forget to subscribe with that notification bell. I have new videos on the way all the time. It's late at night here. I am getting a little tired, but hopefully the video was enjoyable today. Before I go, in terms of a full disclosure, I own the stocks mentioned today. I'm long. I'm going to try to remember them today. Bank of Hawaii, BOH. I am long Bank of Montreal, BMO. I am long Starbucks, SBUX, PepsiCo, PEP, McDonald's, MCD, Johnson & Johnson, J&J. I'm also long Altria, ticker MO. I am also long all of those Vice stocks. I'm long Coca-Cola, KO. I'm long, actually, there's only one more, Hershey. My kids are long Hershey, ticker HSY. why. I own those stocks, or my kids own it with Hershey in our portfolios. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the financial markets and the stock market. Please consult your financial advisor before making any financial moves. I'm just sharing my journey with all of you for fun and entertainment. I love you all. I have additional disclosures, disclaimers in the description below, and I will see you all in the next dividend stock investing video.